request President of AGFTC. I request President of AGFTC, CA Ravi Shah, and President of ITBA, CA Ashish Tekwani, to please escort our brain trustee panelist, CA Mehul Thakkar, Advocate Mehul Patel, CA Aseem Thakkar, CA Mitish Modi, onto the dais. I request brain trustees to please take their positions on the dais. Here I take the privilege and honor to introduce our today's session's brain trustees. To start with, here I introduce Advocate Mehul Patel. He is an advocate with experience of 33 plus years, served as Chalizar and Company Chartered Accountant in the year 1988 and 1989, and at J.S. Parikh and Company Advocates in the year 1989 and 1990. He's got diploma in public speaking from Narzarth Speakers Academy, Bombay in the year 1990. Speakers at various seminars and lectures organized by the various professionals association. He has been elected as the youngest president of Income Tax Appellate Tribunal Bar Association, Ahmedabad, for the year 2007-2009. With these words, I welcome our today's brain trustee, Advocate Mehul Patel. Please give a round of applause to him. Coming on to our next brain trustee, CA Mehul Thakkar. He is FCA, having vast working experience of 25 plus years as a practicing chartered accountant, a rank holder in examinations conducted by ICAI, as an expert in the field of direct taxes, having hands-on experience in providing advisory services, handling assessment, reassessment, assessment in search cases and first appeal. Successfully argued various matters relating to direct taxes before Income Tax Appellate Tribunal, Ahmedabad. He has experience in providing advisory services in the matters pertaining to FEMA and international taxation. Author of a comprehensive book on direct tax laws and international taxation, and he has been the keynote speaker at various branches of ICAI and various forums. He had trained 28,000 plus students pursuing CA, CMA final and 5,000 plus tax professionals in issues pertaining to faceless assessment. With these words, please welcome our today's next brain trustee, CA Mehul Thakkar. Coming on to our eminent trustee, CA Mitish Modi. He is the founder of Messrs. Mitish S. Modi and Company Chartered Accountants based at Surat and Southern Gujarat, Mumbai, Pune and Maharashtra. He is senior advisor to Messrs. Akshay M. Modi and Associates, Surat. First rank holder in BCom and was awarded with Ashwin Mehta Gold Medal by Field Marshal late Shri Manik Shaw. Obtained CA degree in the year 91-92 and cleared his law examination in the year 2002. Regular practitioner in taxation matters relating to income tax, service tax, GST and allied law, consultancy, audit, company law matters and project consultancy. He regularly appears before ITAT and mainly practices in litigation of tax related matters. Sir, here we welcome you all in today's conclave. CA Aseem Thakkar, a chartered accountant and tax professional since 1987. He has been former vice president of ITAT Bar Association, Ahmedabad. Served as invitee committee member of All Gujarat Federation of Tax Consultants. Former chairman of Direct Taxes Committee, Ahmedabad branch of WIRC of ICI. He has been member of Legal and Representation Committee of CAA and member of Taxation Subcommittee of GCCI. He is a regular speaker on Doordarshan Girnar on discussions with regards direct tax matters, union budget analysis, e-governance and income tax, etc. He has been the author of Digest, Income Tax Appellate Tribunal Decisions of Ahmedabad branch. With these words, I request all the participants to welcome our very knowledgeable brain trustees, and we all are set to get a huge, very insightful discussion from your side. Now it's time to felicitate our dignitaries. I request CA Dr. Visvesh Shah to come on the dais to felicitate CA Aseem Thakkar with a book and a token of appreciation. Now I request Advocate Ashutosh Thakkar to come on the stage and felicitate CA Mehul Thakkar with a book and a memento. May I invite Advocate Dr. Kartikeya Shah to please come on the stage to felicitate Advocate Mehul Patel with a token of book and a memento. Now I request Advocate Dhruvin Mehta to please come on the stage and felicitate CA Mitish Modi with a book and a token of appreciation. Thank you all. Now we start with the Direct Tax Brain Trust on issues of direct tax mixed bag. The dais is all yours, sir. Please.
Good evening, ladies and gentlemen. Since we are already a bit late and there are many questions to be discussed amongst all of us, I would straight away begin with the first poser that is there, which is allotted to me. In short, the question is that if during survey certain excess stock has been found, which is disclosed as income of the current financial year and taxes are paid, then whether the tax rate applicable will be the normal tax rate, that is 30% or whatever is the slab, or it will be taxed under section 69 and deeming provision, the tax under section 115 BBE at 60% plus would be applicable. Friends, according to me, if admittedly during survey, in the statement it is mentioned that the stock or the cash has been found and it is generated out of the cash generated from the business, then the source admittedly stands explained. And once you are disclosing the same in your regular books of accounts for the current financial year, for which the return is yet to be filed, then there is no question of applicability of section 69, etc. It would become your regular business income, and it is liable to be taxed at the normal tax rate and not at the special rate under section 115 BBE. For this, we have direct judgments. Judgment of Chennai Tribunal in the case of Overseas Leathers, 152taxman.com, page 595, which has dealt with somewhat exactly similar situation, and also another judgment of Amritsar Tribunal in the case of Nandini Sharma, ITA 148, Amritsar, /2022, dated 10th October 2022. And we also have a High Court judgment which we can, the ratio of which we can rely upon, the Andhra Pradesh High Court in the case of PCIT versus Deccan Jewelers, 132taxman.com, page 73, wherein certain stock cash was disclosed during search of the current year, and it was held to be business income since it was a mixed stock out of business income generated over years. And there the AO had accepted and principal CIT took 263. That 263 was quashed by the tribunal and that decision was upheld by the High Court. Friends, we can also take analogy of the judgments. Earlier we used to have that section, we used to have the controversy regarding section 40B, regarding remuneration paid to partners. And we used to have that dispute that whether if certain amount is disclosed during survey, whether that is business income or income from other sources, and whether if it is business income, then whether it is liable to be considered for the purpose of payment of remuneration under section 40B to the partners. For that also we used to have many judgments. The base decision is Rajasthan High Court decision in the case of Bajrang Traders, 86taxman.com, page 295. So friends, according to me, it is liable to be taxed under normal provisions only. And the last portion, 40A3, etc., in my humble opinion, should not come into play because we are not dealing with bogus purchase or we are not disclosing purchases. What we are disclosing is unaccounted, undisclosed stock. So there is no question, and we are not claiming any purchase, we are disclosing it. So there is no question of applicability of section 40A3. And the last portion of the question is that if at all you are able to relate to a turnover of 12 years ago, whether the income is to be taxed in that year or the current year. Friends, I would only suggest that please don't go into all this and kindly treat it as undisclosed income of the current year only to pay tax at the normal rate and to get out of penalty. Thank you.
The second question is more or less similar to the question which has been answered by Mehul bhai. What would be the implications during the survey if cash is found in excess and if there is deficit cash? Now, in a survey proceedings, when the income tax assessing officer, he comes to your premises, he will check your stock and cash, and other material can also be impounded with the recent amendments in the provisions. There is no utopia. There never is the cash on hand go and tally with your cash found during the course of survey proceedings. There would be generally a deficit or an excess cash. Excess cash, then again there are, as discussed earlier, two implications would be there, whether this excess cash would constitute unexplained money under section 69A and whether the provisions of 115BE would be attracted, or alternatively, the same would be treated as just an excess stock, excess cash arising out of your trading operations and would be taxed as your business income. But in any case, excess cash would be taxable. There is no question or doubt on that count. As indicated earlier also, if in your statement you clearly specify the source from where this cash has been generated, that this cash has been generated by my making of trading sales, which has not been recorded in the books of accounts, then to that extent, it should be treated only as a business income and not as an unexplained money, whereby 115BE section would come into play. There are a couple of decisions which are to that extent. One is Tejpal Singh, 158taxman.com, 679. In this case, the SSE said that I'm making entire sales in cash and I'm doing this medical business, and this excess cash which has been found is on account of my trading sales affected. The tribunal took the view that there is no other source of income which has been unearthed during the course of survey operations. He has already indicated that what is the source of cash. This has not been discredited or disproved, and therefore the provisions of section 69 would not come into play. Similar views have been extended in the case of Pramod Singla, 154taxman.com, 347 Chandigarh. And also, in case of demonetization, if you are well aware that Sohan, cash was being deposited into the bank account, and they used to say, the SSE's contention was that these are my regular sales which have been affected. These have come to be deposited in the bank account, and therefore section 69 should not come into play. Those views have now been, those views which had been canvassed have now found to be acceptable. Recent decision, Suhana Jewellery Exports, 157taxman.com, 680 Chennai. So, if it is cash excess, it will be an income. You will have to establish that this is out of my business sources, this is my regular trading operation, then it will go as business income, otherwise it will be taxed under section 69, and then higher tax rates would be applicable. Pelluvattu, 154taxman.com, 347. Pramod Singla. Tejpal Singh, 158, taxman.com, 679. And cash deposited in the bank jeweler case, 157, taxman.com, 680, Chennai. Coming to the second aspect. Now, suppose cash which has been found is actually lesser than what is indicated in your cash book. There is a cash shortage, cash deficit. Would that constitute income? No, if only there is excess cash, would it constitute income? If there is cash deficit, then it shall not constitute income. Maximum what inference they can draw? That probably you have given out this money out on loan, you are generating interest income, they will accuse you of earning interest. But without such evidences, even those additions would not sustain. So in case where there is cash shortage, you can always say that I have taken it home, it is kept there, I have given it to X person. If that be the reason, no adverse inference can be drawn. Two decisions, ITO versus Subhash Brothers, 51, taxman.com, 422, Kolkata. Though not for cash, but for stocks, because where there was a stock deficit which was found. So what the court said, that at the most, this is sales, unaccounted sales of accounted stock. So what can be taxed is maximum the profit margin. And that is Gujarat High Court decision, Precedent Industries, 258 ITR, 654 Gujarat. Now let's examine that there might be a third possibility, that you have cash surplus and stock deficit. So can you take this, can the AO visit you with such an addition that there is stock deficit, so I will tax you for your percentage profit, and excess cash has been found, so therefore I will tax that at 69 and apply 115 double BE tax rates. Now, one can always make out a case that whatever excess cash has been found is on account of this sale of stock. So benefit of telescoping should be given, and at the most what can be added is the percentage of that income and not that excess cash which has been found during the course of service. So you can have the benefit of telescoping. CIT versus KC Malhotra, 304 ITR, 149, Punjab and Haryana High Court.
Serial number 3. The issue raised here is whether interest on TDS paid under section 201, subsection 1A, and late fees paid under section 234E are allowable expenditure under the head business and profession. As such, we are aware of 201, subsection 1A. It is an interest on late deposit of TDS. Now, generally, we understand the ratio decided by the Supreme Court that if any payment of interest normally is of compensatory nature, and if it is of compensatory nature, then same shall be allowed. And on the other hand, if payment is in nature of penal nature, then it should be disallowed. That is the standard ratio laid down by the court. Now a question may arise, can interest paid for late deposit of TDS, would it be considered as compensatory in nature? Would it be allowable? Look at the, I'll request all of you to note down a very old judgment of Madras High Court, 239 ITR 435. I repeat, 239 ITR 485, where categorically Madras High Court had given its opinion on two aspects. Number one, very important, number one is very important, that these interest, particularly for late deposit of TDS, does not assume the character of business expenditure. Because we know if you would like to claim any expenditure under the head business profession, more particularly under section 37, then we need to prove or we need to establish that it has been laid out wholly and exclusively for the purpose of business. So here Madras High Court categorically held that it does not assume the character of business expenditure, and also held that it cannot be regarded as compensatory payment. So this is the decision against the taxpayer, that it would not be allowable. And this decision was subsequently followed. I request all of you to note down, in case of Velkani Information System, 97taxman.com, 599. It is Bangalore Tribunal. One more, we have got Delhi Tribunal, that is Universal Energy Limited, ITA number 2761, Delhi 2018. There also, the Delhi Tribunal category held that these expenditure will not be allowed as reduction. We got many negative judgment coming from Bangalore ITAT also, but we have got surprisingly one decision in favor of taxpayer that I request all of you to note down, and that is Mumbai Tribunal. It is in case of Resolve Salvage and Fire India Private Limited, and that is 139taxman.com 196. I repeat, 139taxman.com 196. Here Mumbai Tribunal had given favor, but Mumbai Tribunal addressed only one aspect, that whether this interest is of compensatory nature or not. And Mumbai Tribunal held that this interest is of compensatory nature, and that therefore the way interest for late deposit of service tax or earlier VAT or GST is allowed, similarly such interest on late deposit of TDS will also be allowed as reduction. Mumbai Tribunal had not commented upon, or the question was not raised before Mumbai Tribunal with regard to whether it is only and exclusively for the purpose of business. With this, I end this query. Thank you.
Thank you, Mehul. Now the question is whether the provisions of section 48(3) applicable in the case of reimbursement of expenses in cash. Friends, 48(3) laid down some restrictions on the cash transactions. Any expenditure incurred and the cash payment exceeding rupees 10,000, and if it is the payment towards the plying and hiring and the transportation of goods, the limit is of 35,000. The payment or aggregate payment for a day, if it exceeds the limit 10,000 or 35,000, it is going to be disallowed under section 48(3). Now what I understand that this is the question about the reimbursement of expenses in cash. So what I understand, that is the book entry. If I am going to reimburse this certain expenditure, any expenditure is covered, whether it is capital or revenue, any expenditure. So that expenditure, I firstly book the entry, I debit that expenditure in the books of accounts and credit the name of the person to whom I am going to reimburse the said amount. And subsequently, I reimburse the same, debiting the account of that person, and by way of making cash payment. So ultimately, what I can't do directly, it is the mode of indirect payment through cash. So in my opinion, if the payment in excess of rupees 10,000 or payment made to the transporters for the transportation of goods in excess of 35,000, 48(3) will applicable, except the circumstances, unavailable circumstances of the exception circumstances as laid down in Rule 6DD is there, then only there is some way out with the payer not to attract the disallowance under this section. Banking expediency or the banking facility is not available, or other relevant factors. So it is the onus upon the payer to establish that I have made this payment under the unavoidable circumstances or exceptional circumstances, and if Rule DD is available, then there is no disallowance under section 48(3). Payment made for the expenditure in transit.
I paid the advance 15,000 to an employee who is traveling in emergency outside, like he
Okay. Ultimately, it is towards the expenditure for the business purposes. So you are just paying in advance to meet that expenditure. he made the expenditure in cash on behalf of you, and you are claiming that expenditure in your books of accounts. This is not the expenditure incurred by the employee. The provision says that the payment or aggregate payment for a day. So we have to see for a day if it exceeds the limit of 10,000 or 35,000. Act is required actually. So Rule 6 DD will help you in that way because it is the exceptional circumstances. I read some of the exceptional circumstances. If payment made to salary in remote places, it is not covered under section 40A3. If the payment made in remote places, it is covered under the exceptional circumstances under Rule 6DD. So if the payment is going to be made in remote places and you hand over some amount in cash to your employee for that purpose and it has been incurred, so I don't think that 40A3 will apply. So we have to see Rule 6DD. Okay, thank you.
Now I'm taking up question number 4. Sorry, 5. I'm sorry, 5. Basically, the question is that whether addition can be made in respect of unexplained money only on the basis of your mobile SMS messages or WhatsApp messages without any corroborative evidence other than that. Now, friends, let me tell you that mobile and laptop and technology, howsoever useful it is to us, but when it comes in the hands of the department, then I am sure you are in trouble. So you have to be very, very careful because this is one of the most deadly weapons these days in the hands of department because everything is stored in your computer, in your laptop, in your mobile. Now the question is, firstly I must say that it is highly factual. It would all depend on the facts of each case. But I would like to discuss here 3 or 4 judgments which gives broad guidelines as to when such type of evidence, first of all, can be admitted against us and when it can be used for making addition in the case of an SSE. First judgment, a very useful judgment, is of Kolkata Tribunal in the case of Atul Tatia, ITA number 492, Kolkata 2021, dated 28 March 2023. ITA number 492, Kolkata, 2021. Friends, you will find it on the tribunal website, the entire judgment, whosoever wishes to read. In this case, broadly, the issue was that whether addition can be made in respect of unexplained investment, unexplained expenditure, etc., only on the basis of WhatsApp messages without any further corroborative evidence or not. So whether the department can presume that whatever is mentioned in the mobile is a transaction that has taken place, that money has exchanged between the buyer or seller or between the giver and taker, and whether addition can be made or not. Now broadly, 2 or 3 beautiful, it's a very long judgment, but broadly 2 or 3 principles are laid down, which I like to read over here because this is a very burning issue. The first principle laid down is that first of all, WhatsApp messages cannot be considered as a conclusive evidence to draw an adverse inference against the SSE unless those WhatsApp messages are supported by corroborative evidence to indicate that those messages and contents represents undisclosed income of the SSE. Secondly, the AO, without carrying out necessary inquiry and also examining those persons, simply concluded that those messages are meant for distribution of cash and the SSE has spent such a huge amount for election purpose. This is, the AO's action is only on surmises and suspicion. And lastly, the fact remains that the AO should bring some positive evidence to link the WhatsApp message to allege that the contents of WhatsApp messages depicts the undisclosed income or expenses of the assessee. In this case, on perusal of those WhatsApp messages, what we could understand is that those messages are dumb document without any corroborative evidence. So friends, if there is no corroborative evidence, then admittedly it cannot be used for making evidence. Then I would like to discuss one very elaborated judgment of Hyderabad Tribunal, which is in the case of Gavira Reddy Gari Aparna Kalyani in ITA number 3, Hyderabad, 2023. Judgment dated 28 February 2023. ITA number 3, Hyderabad, 2023. This was a group of cases, and this judgment is running into about more than 100 pages. But the importance of this judgment is that they have gone into the provisions of Indian Evidence Act, particularly Section 65 of the Indian Evidence Act, and they have stated that such type of electronic evidence in the form of WhatsApp message or Excel sheets taken from laptop, etc., can be admitted as evidence against the assessee only if the procedure followed under Section 65B of the Indian Evidence Act is completed by the department. And 65B, first of all, requires the production of a certificate from the digital forensic examiner. Only then that evidence can be admitted. Plus, there are so many other conditions that are to be fulfilled under the Indian Evidence Act. So this judgment is, at the threshold. We can always challenge the admissibility of the evidence if they have not followed the proper procedure as prescribed under this judgment and as prescribed under, more particularly under Section 65B of the Indian Evidence Act. So friends, this judgment is very useful as to admissibility of the evidence, and the other judgments are also discussed as to when can it be used against the SSA in respect of corroborative evidence, etc. Then friends, a very useful judgment, a very recent judgment of our own Gujarat High Court, which is in the case of Principal CIT versus Kaushik Nanubhai Majitia in tax appeal number 2020 of 2024, and the judgment is dated 6th March 2024. So just a week back, this judgment is rendered by the Gujarat High Court, whereby the Gujarat High Court, by a speaking order, has dismissed the tax appeal of the department. The tribunal had decided in favor of the SSC, and the department's tax appeal is dismissed by the High Court at the threshold. The question was regarding the search at Navratna premises. We know Navratna organizers, and certain Excel sheets were found from the laptop of the employee of Navratna. And Navratna had gone to settlement commission and paid the taxes thereon. So on the basis of this, the department presumed that whatever is mentioned in the Excel sheet, the transaction has taken place, and issued 153C notices to all the buyers or to all the persons who had booked the houses over there. So in these circumstances, the Gujarat High Court confirmed the finding of the tribunal, and they said that the presumption of the AO that simply on the basis of settlement commission petition by the organizer or the developer, it cannot be presumed that transaction has taken place with each and every buyer. I'll just like to read one paragraph from Gujarat High Court, which is very useful in all such type of cases. That we find inherent fallacy in the submission, in as much as there is no basis for conducting proceedings against the SSC merely for the fact that the developer had paid tax on the amount shown in the Excel sheet. There is no adjudication with regard to the payment which was shown in the Excel sheet to the effect that the same was actually paid by the SSC to the developer. Even otherwise, the concurrent finding of the CIT and ITAT are that the document found from the premise of third party, namely Excel sheet, which is the basis of the proceedings, was without any signature, and there is no corroborative material to substantiate the said document. The nature of the document has not been explained by the assessing officer while proceeding against the SSC. The statement of the persons recorded during the search with reference to the alleged seized material was also not provided to the SSC, and hence the entire proceedings under section 153C stands vitiated and void ab initio. So friends, this judgment can be used usefully for all such type of electronic evidence. And recently I have come across one more judgment of Mumbai Tribunal, in the case of Padma Shri Dr. D.Y. Patil University, in the ITA number 3264, oblique Mumbai, oblique 2022, judgment dated 4th January 2024, wherein certain laptops, etc., found from the employees of the university and their statements were recorded on the same premises, and applying the logic of all these judgments, it is held that such type of evidence from a third party or employees which is not confirmed by the owners or the SSE in question does not have any evidentiary value in the absence of any other corroborative evidence. So friends, these are the illustrative case laws that I wanted to bring to your kind notice. Thank you.
In certain materials are found in Excel sheet, but the date of investment is not available with the department. Can an edition be made?
See, first of all, I also believe that all these judgments says that simply finding a paper in the Excel sheet, that itself cannot be made a basis for addition. Leaving aside the date, first of all. Khali Excel, for example, Navratna, in that the Excel sheet was found from the laptop of the employee of Navratna, wherein detailed figures were mentioned. But still the tribunal and the High Court said that such type of Excel sheet, it cannot be presumed that the transaction has taken place. Unless there is other valuable article or thing found from you, or unless there is some admission or there is some other positive evidence found from the SSE himself. These all, they have termed it as third party evidence. 132(4) bhi nahi lage, a bhi amal lakhelu chhe. So in your case, I would say that it is one step better, that there is no date also.
Only rate etc. is available, date is not available. Where is the
This can easily be termed as dumb document or a quotation or a estimate or whatever. Unless there is some evidence which is found that that transaction has actually taken place.
And second is the basis of edition is the year of booking or year of execution of lease.
Actually, it would depend on the facts. Actually, it should be the year of payment. According to me, the deeming provisions of 68, 69 would come into play only when actual payment takes place.
Payment is spread over 4 to 5 or 7 years.
But then, regarding payment of on money, પેમેન્ટ જે આપણે ચેકથી કરેલું છે એનો તો કોઈ પ્રોબ્લેમ છે જ નહીં, પણ ઓન મની ક્યારે ભર્યું છે એનો એવિડન્સ મળવો જોઈએ ને, એ જ ફાઇનાન્શિયલ યરમાં જાય.
Now taking the view that date of the execution of the deed is the date of the investment under 690.
But that we can easily say that is on presumption, if no other evidence is there. And there may be some problem to the SSE where the check payment is also mentioned, cash payment, and check tallies with your books of account. It would depend that whether in the statement the giver and taker accept it or not, because otherwise this evidence says that still some other evidence is required. Now I don't know what can that evidence be other than the evidence which is recorded in the laptop. But we have to, and as per this judgment, please make sure to ask for all the incriminating material and more particularly cross-examination. Because if the department fails to give cross-examination, then also this evidence cannot be admitted as per the settled law of Supreme Court and Gujarat High Court judgments. Hyderabad tribunal માં એ બહુ જ elaborately discuss કર્યું છે. All the relevant provisions of 65 of Indian Evidence Act, certificate of the forensic officer, everything has been there. It's a judgment running into about 120 pages. So you please go through that Hyderabad tribunal, and we can always, because I am sure that in major of the cases, department is not following this procedure. And the Hyderabad tribunal said that if the procedure of Indian Evidence Act as per 65B, etc. is not followed, then that evidence is liable to be rejected. અને ત્યાં સુધી કીધું છે કે સર્ટિફિકેટ અને the original laptop or the original mobile etc. has to be presented in the court, જેમાંથી evidence મળ્યો છે, which is never done by the department. If that is so, then this evidence is not admissible at all at the threshold without going into the merits of the matter. Hyderabad no? નામ ટિપિકલ હૈદરાબાદી છે પણ બોલું પાછો. ITA નંબર 3/Hyderabad /2023 Hyderabad Tribunal Bench A, and the name is Gavi Reddy Gari Aparna Kalyani. But kindly go by ITA number, you will find it in the tribunal website. 3/2023. That is more material. See, see, if something is found in the form of cash or valuable article or thing which represents the amount which is sought to be added, that can be termed as a valid evidence. Or if there is a chitti with your signature, with the signature of the SSE, કેમ કે ઘણીવાર આપણે જોયું છે ઘણા કેસોમાં એવું છે કે બ્રોકરને ત્યાં ચિઠ્ઠી મળી હોય જેમાં એગ્રીડ એમાઉન્ટ પર બંનેની સહી હોય, department, the seller and the buyer both. If such type of evidence is there, then probably it can be termed as valuable evidence, corroborative evidence.
Question number 6. On 1st February 2024, a search took place at the residential premises of one Mr. Rajesh, and 2 crore cash was found, all with 2000 denomination notes. It was argued that this is not a valid tender and therefore there is no question of unaccounted cash. So now two-fold question is there, whether the argument and the contention of Mr. Rajesh is valid, and would there be any difference if instead of 2000 note we have a 500 and a 1000 note. Now firstly, this question is incorrect in this sense that 2000 note is not an invalid tender. It has not been demonetized as yet. It is still legal tender. You can still exchange in the 19 RBI offices, and there is a circular which has been issued by the RBI, question answer FAQs, which is dated 30 September 2023. In question number 3, it has been answered by the RBI. The question is, does the legal tender status of 2000 banknote remain? Answer is yes. The 2000 banknote will continue to maintain its legal tender status. Then again, is there any provision? Because this deadline for depositing 2000 cash denomination note was 30th September, which came to be extended to 8th October. So now post 8th October, they said that no, now banks will not accept your cash. You will have to go to the RBI. And the other catch is that at a time you can only deposit 20,000 rupees. You cannot deposit in excess. So this Mr. Rajesh will have to go 1,000 times, I calculated, for this 2 crore notes if he wants to deposit with the RBI, which is going to be a slightly difficult proposition. And if he is not in a place where RBI is located, even more difficult. Now that apart, so first and foremost, it's a valid tender money. So you cannot make out an argument that it's illegal and therefore you cannot treat it as my unaccounted income. Now, how do you escape from that? Because there are no decisions to back on for this. So only arguments which you can raise to explain. Then you will have to ensure that since 30/9/2023, which was the last date, you should have had cash on hand balance in excess of 2 crores. So you can always make a claim that 2 crores was prior to 30/9/2023, which is still lying with me. I have been lazy. That is my problem, but you cannot tax me for being lazy. I did not go and deposit. If at any point of time, post 30/9/2023, your cash on hand goes below 2 CR and now 2 CR is found, then you are in trouble. Because that would indicate that this cash 2000 currency note has come to you post 30th September and all consequences would follow. So that would be one thing which you need to take time care of. Now coming to the second portion, whether there would be any difference if the old denomination notes are of 500 and 1000 have been found. 500 and 1000 notes are illegal tender, and if it is found in your possession as on date, you are in serious trouble. What they had originally envisaged by way of punishment was that what they say today, even today, if you are found with a 500 or a 1000 currency note, the law is that at the most you can have 10 notes. You cannot, that notes cannot exceed 10 in number. Now, what would be the penalty? 5,000 rupees or 10 times the amount of notes which have been found. So can you imagine 2 crores and 10 times the penalty? So if that man has kept it, he is very stupid, he should immediately dispose it of. Because I don't know what he will have, from where will he pay the penalty? That would be the next question. So in no ways should you keep. Now, whether, see, demonetization took place on 8th of November 2016. So the possibility, if you have been subjected to search, with the new provisions, you can be taxed, your reopening can be for assessment year 21. If it is 1/1/2024, your date of search, it would be 23-24, 22-23 and 21-22. These 3 years are mandatorily to be reopened. You can go ahead for 7 years. So that would cover right up to assessment year 14-15. But there is a further limit that 50 lakh rupees, there should be minimum escapement for all the years or even in a single year. Then to that extent, you can go back to from the 4th to the 10th year. Now suppose this Mr. A has been found with this 500 and 1,000 rupee cash note. And he is aware that this is completely wrong. His family members totaling are, say, 8. In his statement, he should inform that all this 22 crores are belonging to all 8 of us. So that is 25 lakhs each only, which belongs to me. Now you can reopen you cannot reopen because it is not exceeding 50 lakhs. So that way, that is the only escape route which I see at the present juncture. Otherwise, you are in deep trouble if these notes have been found with you.
Next, serial number 7. Partner receives salary from the partnership firm, and that amount is 1.5 crore. The issue raised here is, what are the implications under 44AD and 44AB? Many times we have this kind of ticklish idea that I have received salary, partner salary from a partnership firm. So can I go for 44AD if it is a business salary received from the business? And if it is a profession, can I again go for that 50% of 44AD? In that, I request all of you to note down Madras High Court in case of Anand Kumar versus Assistant Commissioner of Income Tax, 122taxman.com 252. I repeat, 122taxman.com 252. Where Madras High Court interpreted word turnover appearing under 44AD, because we know that benefit of 44AD will be allowed subject to your total turnover shall not exceed prescribed limit, which was earlier 2 crore, now it is 3 crore. So where the total turnover, that word has been subject matter of interpretation by the Honorable Madras High Court, where Madras High Court says that the word used are total turnover, gross receipt, and it presupposes that it pertains to a sales turnover. Therefore, while interpreting this word total turnover gross receipt under section 44AD, court held that it presupposes that it pertains to a sales turnover and no other meaning can be given to the said words. And court further held that if it is done so, that means if you would like to give other meaning like remuneration would also fall in this word turnover or gross receipt, then purpose of introducing section 44AD would be defeated. Therefore, Madras High Court conclusively held that sales turnover and gross receipt does not mean this remuneration. It would mean only a turnover or sales coming from the business. Therefore, you cannot take advantage of that 8% of 1.5 crore. And moment here the interpretation is on word turnover, so section 44AB we will also have the same wordings of turnover. So you can apply this judgment of Madras High Court. Thank you. Sorry. Same, because ultimately where the similar wordings are used. You cannot take advantage under 44ADA for the partner's remuneration. It has to be offered in full for the taxation. Yeah. You have to offer entire remuneration, eligible remuneration which you are drawing, which firm had claimed deduction. To that extent, it will be taxable in the partner's capacity. That should be offered full. You cannot take advantage of 44 ADA for that. Sorry, 75 lakh? Other professional? The 44 ADA is applicable for specified professionals only. If you read the provision 44 AA subsection 1 categorically says, therefore you have to say whether it falls in specified profession. Thank you. Sorry, director. Hearing problem.
Can you please speak a little louder, please?
Direct consultancy, you see, consultancy would fall, yes. I think your question is, director has been paid consultancy fee, not the salary. So in that case, consultancy will definitely a part of gross receipt, because gross receipt, in that case, you have to see that it will be a part of gross receipt. You have to again check it out that whether it is falling under 44 AD or 44 ADA. If it falls under 44 ADA, you can take advantage of that consultancy up to 50%. But I request all of you that 44 ADA and 44 ADA, law is very clear. It should be minimum 50% or minimum 8% or 6%. That means if you earned higher, then it is actually incumbent upon the taxpayer to declare higher income. Law is very clear. And there are plethora of judgments which clearly says that you may not be perhaps questioned on this income earned under 44 AD and ADA you declared. But so far as your investment under section 69A, that can be questioned. You cannot at a time take a plea that I am falling under 44 AD or ADA. You have to justify your investment. And that is the reason I always recommend that if you have earned higher income, then it is advisable to declare higher income. These are the minimum income prescribed under the Act.
There are judgments that in such a case of partner remuneration, 44 AD is applicable and you can be penalized for not getting the tax audit.
Here idea is that 1.5 crore, like in this example, would be a part of your gross receipt. And then you have to see if coupled with other turnover, if it exceeds the threshold limit. But of course, then again, we have got, this is definitely by an accounting adjustment. You are not receiving this 1.5 crore partner remuneration is just an accounting adjustment. And we have got again that limit of 10 crore under 44 AB clause number A. That up. So we have to see that 5% cash transaction and 5% payment and receipt, accordingly we have to take a call about that. But it will be considered as a part of your turnover. That 1.5 crore will be considered as a part of turnover. Yeah. If it exceeds, yes.
44 AD applicable then.
44 AD, AB, that is what I am saying. It is, your turnover would be considered as 1.5 CR or gross receipt. Better word is gross receipt, not a turnover, but it will be considered as a gross receipt. So accordingly, we have to see that limit is of 1 crore. Then in that case, they may subject you to a tax audit for a single entry. That is what I am. 44 limit is 1 crore, subject to a higher limit of 10 crore. That is the point. Now, point is that this receipt would be a part of your gross receipt. There are two words are used under 44 AB, gross receipt and turnover. So this should be considered as a part of your receipt. So coupled with other receipt, you have to see that if it exceeds the limit prescribed, so backward say etla lage audit.
Okay? Proceed. My question is literally very long. I will take 2 hours. Explain the difference between the relevance and the ambit of deeming provision under section 68, 69, 69 ABC. These are the deeming provisions governed under chapter 6 of the Income Tax Act. And we all know what are the implications, relevancy and the importance of these judgments, these provisions. But I summarily touch the provisions. Section 68 provides for the unexplained cash credits in the books of accounts. So maintenance of books of accounts is mandatory. If there is no cash credits in the books of accounts, if there is no books of accounts, then there is no applicability of section 68. But one more point is important, that the amendment has been made by substitution of the first proviso below the section 68 by the Finance Act 22, and now it is with effect from 1/4/2023, that is from the assessment year 23-24. That provides that when the sum is credited, some cash credit is there, so person in whose name the credit appears in the books of accounts, now he is also supposed to establish the nature and source of the credits. Now one more limb to prove the identity, creditworthiness and the genuineness of the transaction is now inserted in the statute. So in the coming days, when the regular assessment is there, one more area of litigation will arise. In short, insofar as 68 is concerned, we have to now prove the source of the source in the cases of the taxpayers other than the corporates. This is 68. Now second one is 69, that provides for the unexplained investments. If there is an investment and it is unexplained or explanation given by the assessee, it is not found satisfactory to the assessing officer, then the provisions of section 69 will be applied. Section 69A, unexplained money, bullion, jewelry or other valuable article in any financial year, the assessee is found to be the owner. This is very important. 69 provides for the unexplained investments. Now 69A provides for the ownership of the money, bullion, jewelry or other articles. This is the distinction between these two section 69 and 69A. And the 69B that provides for the amount of investment, etc., not fully disclosed in the books of accounts. So if there is books of accounts, whatever the difference between the fair market value and the amount recorded in the books of accounts, the deeming provision section 69B. Then 69C, unexplained expenditure. The expenditure incurred but no explanation is given or the explanation given is not found satisfactory. It is going to be taxed as the income under section 69C. One proviso below this section, this is very important, that notwithstanding anything contained in any other provisions of the Act, that is, this is the non-obstante clause in this proviso, that such an unexplained expenditure which is deemed to be the income of the assessee shall not be allowed as a deduction under any head of income, meaning thereby whatever addition made under section 69C, it is going to be taxed at the highest tax rate, 30%. So far as section 69 and 69A is concerned, unexplained investment and unexplained money. Very recent decision of the Supreme Court is there. In the case of DN Singh versus CIT, 454 ITR, page 595, the Supreme Court has made a very detailed analysis and distinction between the provisions of section 69 and 69A. Very important judgment and very recent judgment. And insofar as 68 is concerned, we have Rohini Builders of the Gujarat High Court, and the SRP filed by the department against this Gujarat High Court decision has been dismissed by the Supreme Court. Now that judgment is approved. There are so many judgments on 68, unexplained cash credits. So I will not touch, but it's the summarily the implications and relevance of the deeming provisions under section 68, 69, 69A, B, C. Thank you.
Okay, question number 9. This is regarding penalty under section 270 capital A. Now the question is that addition is made under section 14A of the Act, and penalty is also sought to be levied. Now, SSC applied for immunity from penalty under section 270 capital A, double A of the Act, but the department said that no, this penalty is for misreporting of income, so we will refuse the immunity and penalty will be levied. Now, is the action justified or not? Friends, if we see section 270A, then there are two limbs, underreporting and misreporting. Now, misreporting is clearly defined in subsection 9, 270A subsection 9, and there are 6 clauses, A, B, C, D, E, F. If your case falls under one of the 6 clauses, then it would be a case of misreporting of income. 3 are relating to your books of accounts, that is failure to record investment, recording false entry in the books, or failure to record any receipt in the books. And 3 are regarding your conduct during assessment and subsequent proceedings, that if there is misrepresentation or suppression of facts, or if the expenditure is not substantiated, which is claimed, or failure to report any international transaction. Only in these 6 cases, the penalty can be levied for misreporting of income, and if your case falls in this, then it would be 200% penalty and immunity will not be granted. But friends, any and every case cannot be termed as misreporting as in this case, because 14A disallowance is simply made on a difference of opinion between the SSC and department, because 14A is made generally out of your audited books of accounts where the facts and figures are not found to be incorrect. It's only a mechanical application of Rule 8D. Then in such cases, the immunity, it cannot be said that this is a case of misreporting of income. It would definitely be a case at best for underreporting of income. And for this, we have direct case law of the Delhi High Court, which is in the case of Prem Brothers Infrastructure LLP, 142 taxman.com, page 38, Delhi High Court, wherein, friends, now the law developed. The Delhi High Court has referred to another Delhi High Court judgment in the case of Schneider Electric South Asia, where, friends, now the law developed by the High Court is something similar to what we had for penalty under section 271(1)(c), that at the time of issue of show cause notice itself, the department has to clearly specify that whether it is a case of misreporting of income or underreporting of income, and if it is a case of misreporting of income, then under which limb they are trying to rope in the penalty, A, B, C, D, E, F. So the department has to give a very, very specific show cause notice for misreporting of income. Only then the penalty is valid. If that is not done, if a general show cause notice is issued, then the penalty is invalid. Friends, we used to have case law for 271(1)(c) penalty also, that it cannot be for both, that concealing income or furnishing of income. Something similar is developed as far as show cause notice for this type of penalty, 270A penalty also. And recently, the Pune Tribunal, I would like to give this citation because this Pune Tribunal judgment has referred to about 10 or 12 judgments very useful on this penalty, which can be usefully applied and kept in mind. This Pune Tribunal is in the case of Shri Shivaji Dattatreya Sonawane in ITA number 708/Pune/2023, and the judgment is dated 2nd February 2024. So friends, in this judgment, they have discussed about 12 or 13 judgments which are useful, and in this case also, the penalty was struck down only on the ground that the show cause notice was not specific. Thank you.
Are you regarding 50C? 50C?
This is an issue of 50C. Yes,
There is one question to me, I will discuss.
50C, this is 50C, it is not about the deeming provision.
Whether they can issue
At the time of issue of show cause notice, in the show cause notice, he has to be very clear that under which limb he is proposing to levy penalty. That whether if it is for misreporting of income, that under which clause, A, B, C, D, E, F, કયા ક્લોઝમાં પેનલ્ટી લેવી કરવા માંગે છે સ્પેસિફિક હોવું જોઈએ. If it is not there, then the entire penalty is void ab initio. This is what the ratio of these judgments is.
I request the participants to only talk about the existing questions going on. Otherwise, we have 32 questions, so it will be not over up to 9 o'clock. So we will strictly go with this, and if you have any query, then after the session, you can talk to the respective faculties. Thank you.
So what he is saying is paid advice is more reliable.
Next question is question number 10. It's about an NRI issue. રવિભાઈ છે એટલે I think ખેડા જિલ્લો આવ્યો છે. NRI issue તો આવે જ. The issue is that Mr. and Mrs. Patel are citizens of India and also residents of India. They possess green card. Miss C is the only child of Mr. and Mrs. Patel and is a US citizen and a non-resident in India. Mr. Patel holds several movable and immovable properties in India. Mr. Patel seeks advice for passing inheritance to daughter in US with all compliance and tax impact. First and foremost, I'm going on this assumption that the daughter is also a major. Otherwise, it will become a very clumsy, complicated answer. So let's keep things simple. Assuming that she is a major, first and foremost, there are no inheritance taxes as of now in India. So whatever movable or immovable property which belong to Mr. and Mrs. Patel can either be gifted or they can be bequeathed by way of a will. For a will, you will be able to avoid stamp duty. Otherwise, in case of a gift tax, if you want to give the property by gift, in case of immovable property, you will be attracting a stamp duty to that extent. But other provisions of section 56 would also not come in place because this is a transfer to a relative. So as of now, there is no inheritance tax, so there is no problem in moving the property. Now, the property has come into the possession and ownership of the daughter. She is a US citizen and a non-resident. So what would be the status of these properties? Now, till she holds the property, she would be generating some kind of an income, which could be in the nature of interest or rent or whatever. Even a non-resident, in respect of income arising or accruing in India, as per section 5, 6 and 9, that income would be taxable in India. So, to the extent to which the property has been bequeathed and the source of that income from that bequeathed property is Indian, she will be taxed in India. Now in US, she has to report both the global assets and the global income as per the FATCA. So this income which has been generated and earned in India and offered to tax in India will also be included in US. But the taxes which have been paid here, the TRC would be issued and that credit for the taxes which have been paid in, which are liable to be paid in US because of the global accumulation, that credit would be, she would be entitled to. So therefore, what care one should take is that in respect of the income which is generated and the investments which are made in India, they should not be in exempt assets. કે આપણે એમ થઈ ગયું કે દીકરીના પીપીએફમાં પૈસા રાખી દઈએ એટલે મજા આવી ગઈ અને 6-7 લાખ રૂપિયા એને એક્ઝમ્પ્ટ ઇન્કમ ઇન્ડિયામાં કોઈ ટેક્સ નહીં. આપણે તો ફોરેનવાળી છે ને દીકરી, કોઈ ચિંતા નથી. That will have an adverse impact because what is going to happen is that global income will be there in US, so that 6 lakh will have to be included. Now here you are not paying taxes on PPF interest, so no credit for taxes you will get there. So these kind of things you will have to take care. Now this is to the extent to which she holds the asset and generates income and offers it to tax. The next stage would be that now she decides to liquidate or monetize that asset. If that be so the case, normal capital gains would be, she would be liable because that income is arising in India. She will have to pay her taxes. Again, global income and all that I'm not getting into. So, and apart from that, as per US, a non-resident, she can remit $1 million per year, which will be tax-free in US. I do not have the exact circular number or that instruction number of US, but $1 million under that liberalized scheme, she can take it back, and that period will be reckoned and beginning from January to December. So it will not be April to March, because you will have to follow the US calendar year, and that would be from January to December. In broad, these would be the provisions, and these would be the compliances which would be required. Keep all the questions later on, otherwise we will not be able to finish.
Serial number 11. Would the depreciable asset forming part of block of asset on which depreciation is being allowed since its acquisition change its character if it is not used for business purpose for last 2 years, to the effect that gain arising from its transfer be considered as long-term gain instead of short-term gain? The issue is here that I am transferring, or I am giving effect, or I am transferring the asset which is depreciable asset. And we know that for depreciable assets, section 50 will come into picture. And section 50 says gain or loss arising on transfer of depreciable asset will be deemed to be a short-term gain or loss. Now the question here specific is that my asset is a depreciable asset. Only point is I am not using it for few years. Since last 2 years I am not using it for business purpose. Can I take an advantage that now this building, let us take an example of building. That building I have not used for business purpose last 3 years. It is under lock and key. Let us take it an example. Earlier I was using for business. I have claimed depreciation also. Today it is a part of block, but I have not used for last 2 years. So can I say that now this asset is no more a part of block, and accordingly I can take an advantage of long-term capital asset where asset is being held more than 24 months, being an immobile property. I request all of you to note down a direct Supreme Court judgment of 2021 on that. It is Shakti Metal Depot versus CIT. I repeat, citation, Shakti Metal Depot versus CIT, 436 ITR 1. Where Supreme Court clearly said the building forming part of block of asset would retain its character as such, even if one or two of the asset in the block were not used for business purposes in the last couple of years. And therefore, capital gain arising on sale of such asset would be short-term capital gain. So here it would not undergo your asset, nature of asset would not undergo change. It will continue to be a part of block, and in that case, Supreme Court clearly held that it is treated as short-term capital gain. If it is a loss, then you can take it short-term capital loss. I repeat citation, 436 ITR 1. Thank you.
Next question. Addition made purely on the basis of the statement of third party, invocation of section 68, read with section 133, capital A of the Act, no cross-examination permitted. It is very much clear. There are two parts. The one part I will touch, no cross-examination. This statement of third party, it is the pure violation of principles of natural justice. There are so many judgments. Ahmedabad Timber Industries judgment is there. 38 GSTR 117 Supreme Court. Then a very old judgment 125 ITR Kishan Chand Chelaram. Two landmark judgments. When there is no opportunity given, it is the pure violation of principles of natural justice, and therefore simply relying upon the statement of third person or any material gathered at the back of the SSC, the assessment based on that statement or the material, it is going to be invalid or quashed. This is one part. Another part is the statement recorded under section 133A. The statement may gather some information, but as held by the Supreme Court in Kader Khan's case, the statement are not recorded during the proceedings under section 133 capital A, survey proceedings. It has no evidentiary value. So it cannot be simply relied upon whatever statement given by the third party. Whether it is admitted or not, it is based on some material gathered. If the assessing officer has applied the presumption under section 292C also, even then, if the SSC is not given any opportunity to cross-examine the third party whose statement has been relied upon by the assessing officer, the whole proceedings is going to be quashed. Citation Andaman Timber Industries 30th GSTR 117 Supreme Court, Kishinchan Chellaram 125 ITR, page I am not having presently, but you can make research on your site. Then another judgment, Sigma Casting Limited versus Deputy CIT, Lucknow Tribunal, ITA number 510-2512, Lucknow LKW, /2019. And one judgment of the Supreme Court, one more judgment, CIT versus Odeon Builders Private Limited, 110taxman.com, page 64. Supreme Court na ત્રણ આવી ગયા.
Okay, now I am taking question number.
110taxman.com, page 64.
Question number 13. Can opening balance be added under section 68 of the Act or not? Friends, the answer is a loud no. Opening balance can never be added under section 68 of the Act. The confusion is maybe because the section itself, the first line and the last line, if we read together, the answer will be very obvious. The first line says that where any sum is found credited in the books maintained for any previous year. But then the last line says that if the explanation is not given which is satisfactory, then it will be deemed to be income of that previous year. So the importance is of the word that previous year appearing in the end of the section 68, and which can have only one meaning, that amount can be added only in the year in which it is first received and it is first appearing in your books of accounts. And for this we have direct judgments. Bombay High Court in the case of Ivan Singh, 116taxman.com, page 499, and Delhi High Court in the case of CIT versus Usha Stud Agricultural Farm, 183 Taxman, page 277, Delhi High Court. Friends, in my humble opinion, if a sum is not added under section 68 in the first year, and if the amount is carried forward as closing balance and opening balance in succeeding years, then according to me, the only section that can be invoked by the department is section 41(1). In a later year, if the department says that no, this sum is now no longer liable to be discharged, this credit liability is to be taxed, then the only section that can come into play is section 41(1). But for that also, the department has to prove the various conditions as required under section 41(1), that firstly, the sum was claimed and allowed in the assessment of any preceding assessment year, and secondly, during the current year, there is cessation of the liability, remission or cessation of the liability, only then 41(1) can be invoked. And for 41(1), only for useful reference, I will give one beautiful Gujarat High Court, the case of Dattatri Poultry Farm, which is 104taxman.com, page 366. Thank you.
Question number 14. A search has taken place, but there is no seizure of any asset. Material has been requisitioned under section 132A, but is not a very productive material. In both these cases, where even seizure, or even when in both the cases, or even under the case where seizure has been made, but no undisclosed income has been discovered, whether search assessments could be still made by issuing notices under section 148. Yes, it can be made. It will be made. Both the things. Let's be very clear. The provisions of section 148 now are concerned with searches which take place after 1/4/2021. Prior to that, we had 153A proceedings. Now, in 148A, 148, explanation 2 has been specifically introduced, which clearly lays down that in case of a person who has been subjected to search, in case of a person who has been subjected to requisition proceedings, in case of a person who has been subjected to survey proceedings, other than TDS survey, a person whose documents, money, valuable article thing has been found in the search of a third party, a person whose documents have been found which contain information relating to him in case of a search of a third party, all these persons, all these 5 categories would be now subjected to 148, and even the procedure laid down in 148A will not be required. So there is direct issuance of notice under section 148. Now the moot question here would be whether 4 to 10 years, if that it is in excess of 50 lakhs, whether for those particular 6 years, 7 years, would any procedure be required to be followed? Whether you will have to record your reasons, because that is still slightly ambiguous, that if you do not bring on record that there is more than 50 lakhs, how will you reopen for beyond? You are going away with the procedure of 148A, fine. But 148A, where there are limits laid down that you can only go to certain years beyond the specified period, subject to certain conditions, those conditions, whether they will have to be met in case of a cert proceeding or not, I think that will be a subject matter of litigation and only the courts will be able to decide. But yes, in any case, you will be subjected to assessment proceedings. Now, even in case of a search which had taken place before 1/4/2021, at that point of time, provisions of section 153A were triggered. Even in those provisions, notices were issued for the 6 years, assessments had to be done. The only saving grace was that if there was no incriminating material found in respect of completed assessments, you were relatively free. Then no adverse inferences would be drawn unless there was incriminating material. Now you are subjected to full 148. There is no limited scrutiny. So apart from what has happened, they will question your cash credits, your loans may have been repaid, you will be not able to get confirmations, they will make additions of cash credits, they can make additions of GP, irrelevant to any incriminating material found. So these are going to be more draconian and more difficult provisions in the coming years as compared to 153A, where the law had comparatively settled. Because in 153A, what was happening was that if there was no incriminating material found, and even during the course of assessment proceedings, the AO finds that no, you have taken the share capital and which is from an accommodation entry provider, nothing could be done by him because there was no incriminating material found in respect of a completed assessment. So that way, there was a substantial relief which was there in the old provisions. But new provisions, yes, notice will be issued, reassessment proceedings will be undertaken, and a normal assessment scrutiny will be done of both incriminating and non-incriminating material.
Serial number 15. Can bonus shares received by the shareholders be taxable under head income from other sources as per the provisions of section 56 subsection 2 clause number 10, because they are received without consideration. We are aware of section 56. Earlier it was subsection 2 clause number 7. Then finally governing provision at present is clause number 10. It takes care of variety of situations where first is money received without consideration. Second is you receive an immovable property where the value of immovable property is lower than the stamp duty valuation. It also deals with immovable property or movable property received without consideration, and similarly for a movable property received for a value less than fair market value. If you take it here, the argument is bonus shares I have received, and definitely we know that bonus shares are being allotted for which we are not required to pay anything because we are already holding some existing shares, and it is the action by the company. If company would like to declare bonus, they would like to convert their accumulated reserve into share capital, then they may take it by decision and they will allot the bonus shares. Now practically I am receiving shares, it is a fact, and I am not paying it, it is also a fact. Apparently a question may arise, I am receiving movable asset without consideration, therefore I may prima facie fall under 56 subsection 2 clause number 10. With that, we have got a wonderful judgment of Karnataka High Court. I request all of you, first of all, note down citation, then I'll read the relevant findings. It is 431 ITR 250. I repeat, 431 ITR 250. It is PCIT versus Dr. Ranjan Pai. It is in favor of the taxpayer. I am reading the governing para. Here, Karnataka High Court had relied upon the Supreme Court decision in case of GIC earlier. It is of 2006 decision, where I am reading that relevant governing para. Issue of bonus shares by capitalism reserve is merely a reallocation of company's fund. And this is the wordings used in used by Supreme Court in GIC's case, that there is no inflow of fresh funds or increase in the capital employed, which remains same. Total funds of the company remains same, and issue of bonus share does not result into any change in respect of capital structure of the company. Thus, practically there is no addition or alteration to the profit making apparatus, and therefore total fund of the company remains the same. Now coming to a governing very detailed part where Karnataka High Court said, in substance, when shareholder gets bonus shares, the value of original share held by him goes down, and the market value or instruction value of these two shares put together will be normally same or nearby the same. So practically it is your original holding, which was original shares, value of it will go down moment bonus shares will be declared. And thus any profit derived by the SSC on account of received bonus share, even if we assume that there is a profit to the SSC, it will be adjusted by depreciation in the value of equity shares originally held by him. And therefore, Commissioner of Appeal as well as Tribunal rightly held that when there is an issue of bonus share, money remains with the company. I repeat, when there is issue of bonuses, money remains with the company and nothing comes to shareholder. Because as such, there is no transfer of the property, and therefore provisions of section 56(2), earlier it was subclause 7, now it is 10, of the Act are not restricted to the facts of the given case. Thank you.
Question 16. Whether the assessment order passed without issuing a notice under section 143(2) is valid. The wordings used are the without issuing. Mehul bhai, remember that 10 years back we have the issue of very litigation on the subject of issuance and the service of the notice, 142 before the tribunal and High Court. Then the insertion of the provisions of section 292(b), that is the notice deemed to be valid in certain circumstances incorporated in the law. 282A provides for the service of the notice. Now the question, the query says raise the issue. The assessment made without issuing notice, that is the statutory notice under section 143(2). Very old judgment of the Supreme Court, CIT versus Hotel Blue Moon, 321 ITR 362 Supreme Court. Very old judgment. But recently, this Supreme Court has delivered one judgment in CIT versus Lakshman Das Khandelwal, 417 ITR 325. The Supreme Court has explained the difference and observed that in a case where there is no notice under section 143(2) of the Act, it was ever issued. But while making the distinction between the cases where the SSC participated in the proceedings and notice what was not served upon him, the word used is served upon him, not issue, or not served upon him on time, or served upon him in improper manner, then the provisions of sections 292(b) of the Act would come into play in favor of the revenue. Means if there is a service of the notice, not merely issuance, service of the notice, and there are some lacuna in the service of the notice as provided under section 292(b), but the SSC participated in the assessment proceedings, then it is the valid assessment proceedings. This is the judgment of the Supreme Court in Lakshman Das Khandelwal. But further it is held that where there is no notice at all under section 143(2) of the Act was ever issued by the department, then it is in favor of the assessee. In the absence of issuance of statutory notice under section 143(2), the assessment order is going to be quashed. It is without jurisdiction and non-est. Citation Hotel Blue Moon, 321 ITR 362, and CIT versus Lakshman Das Khandelwal, 417 ITR, page 325. Two judgments of the Supreme Court. One judgment in 2010 and the latest judgment is 2019. So this is the distinction between the issuance of the notice and the service of the notice. We have to see 292BB also. Thank you.
Okay, question number 17. The issue is that the SS is a company engaged in business of construction and development of infrastructure facilities like roads, canals, bridges, etc. It claimed deduction under section 80IA(4) of the Act. However, department is seeking to disallow by invoking explanation after subsection 13 by holding the SSE to be only a works contractor and not a developer. So whether the action is justified or not. Friends, this was a very, very debatable issue until now, because primarily the explanation and the main subsection 1 are diagonally opposite to one another in my humble opinion. Because subsection 1 says that this deduction is available to a person who is in agreement, who enters into agreement with the government, central government, state government, authority, etc. for an infrastructure project includes construction of roads, bridges, canals, irrigation system, etc. But then in the end they say that this deduction will not be available even if it is in with the agreement with the government, if the work carried out is in the nature of works contract. Now difficulty is that works contract is not defined in the Act. So the department is always saying that you are only a contractor, you are only acting as per the advice of the government, you are not doing anything, you are not undertaking anything, any risk or financial involvement. So we will not give you the deduction. Friends, if the department's view is to be upheld, then according to me, this section would become redundant because nobody would get the deduction. Because in entire India, the entire infrastructure development is carried out by tender system only, where the government contractors bid for the tender and the lowest bidder is awarded, and then he undertakes all works right from work start to finish, and even after finish, for maintenance of the facility for 12 months, 18 months. So based on the terms of the contract, friends, now we have very good judgments of the Ahmedabad Tribunal, and recently the Ahmedabad Tribunal judgment in the case of Monte Carlo Limited has been affirmed by the Gujarat High Court by a very speaking order, whereby the department's tax appeal has been rejected by a very well reasoned order. I would like to give and that judgment is rendered by our chief guest who inaugurated the seminar in the morning today. This judgment is in the case of tax appeal number 786 of 2023, in the case of PCIT versus Monte Carlo Construction Limited, dated 19 December 2023, wherein the detailed judgment of the tribunal is affirmed by the Gujarat High Court, and they say that basically, if we look at the entire tender, the SSE is undertaking a lot of risk, and also financial investment is also there in the form of, because once he is given the tender, he has to give the security deposit, he has to give the bank guarantee, then he has to arrange for the materials, plant and machinery, the qualified personnel, architects, engineers, etc. Then there is retention money, defect liability clause, liquidated damages clause. All this put together shows that the SSE is undertaking a lot of risk, a lot of financial involvement, without which this construction and development of the infrastructure facility would not have been possible. And they say that such type of work cannot be termed as work contract, but it has to be termed as a developer for the purpose of Section 80IA 4. And friends, we can also take some useful help from a Supreme Court judgment in the case of PCIT versus MBL Infrastructure Limited, which is 155taxman.com, page 657, wherein the SLP was dismissed against the order of High Court. It was a 263 matter, but the analogy is useful. It says that the SLP is dismissed against the order of High Court that where the SSE, a road infrastructure development company, has not only employed plant and machinery and other assets along with staff, but also it has been bearing all risk involved in the said infrastructure project. The SSE could not be treated as a mere works contractor, and since the SSE was granted deduction under 80IA 4 in the past years also, as per rule of consistency also, 80IA 4 should be allowed. 155taxman.com, page 657.
Question number 18, it has got further 6 questions therein. Whether income tax, I'll run through the questions and because otherwise we'll not be able to finish off within time. Whether the Income Tax Appellate Tribunal is entitled to adjudicate on the legality of the survey proceedings which are purely administrative in nature, which is purely an administrative action. I think it has been answered. If it is an administrative action, no. But coming to the point, there is a difference between 132 and a 133A. In 132, the specified authorities, they must have reason to believe, in consequence of the information, they must have some reason to believe that this is a person who has not disclosed his income completely and or he's owning assets XYZ which are not fully represented or commensurate with his declared income. In case of a survey, if you look at the plain wording, the Act itself says, notwithstanding anything contained in any other provision of the Act, an income tax authority may enter any place within the limits of the area assigned to him, any place occupied by any person in respect of whom he exercises jurisdiction, so on and so forth. So there is no possession of any information, there is no need for any information, nothing. He can straight away enter. Now this is purely an administrative act which they exercise. Tribunal at best is a fact-finding authority and the final on fact-finding authority. It should not be generally, this is my personal opinion, and I have not even come across any decisions where the tribunal has commented otherwise on the legality of survey proceedings. No, they should not be commenting also, that is also my personal view, that one has to go only under Article 226 before the High Court. One. Second issue is whether there is any illegality in carrying out survey under Section 133A for the purpose of verifying the compliance of provisions relating to deduction and collection of source. 133A 2A clearly provides that you can conduct a survey for TDS purposes. What it reads is, without prejudice to the provisions of subsection 1, an income tax authority acting under this subsection may, for the purpose of verifying, this is the word, that tax has been deducted or collected at source in accordance with the provisions of heading so and so, so and so, so and so, may enter. So only the modalities have been given. He may enter when? After sunrise and before sunset. Any office or any other place where the business or profession is carried on within the limits of the area assigned to him. So for the purpose of verification of the TDS compliance, whether it has been properly deducted, whether it has been deposited in time, he can enter the premises. There is only 2 restrictions in a survey which is carried out. That is, he has no right to check 2 things, which are, one is, he cannot verify cash and stock or other valuable articles or thing. That he cannot do. He can only be restricted to this activity of verifying your tax liabilities. So the second question is, yes, it is completely legal. Third is, whether any statement recorded during survey action should be considered as validly recorded, and if so, what is the evidentiary value? This similar question has been posed to Mr. Mitish Modi, and he has answered it. I would repeat the same thing, but there's a catch here. Now, S. Kader Khan and Sons, which he referred to, 352 ITR 480, they say that a statement recorded during survey proceedings has no evidential value. Now, the reason why is that there is a difference between a statement recorded under 132.4 and a statement recorded under 133A. In 132.4, the primary conditions are that the statement which is recorded on oath, that is a sworn statement. It is recorded during the course of search proceedings, that is after the execution of the warrant and before the final PO is lifted. So during the course of search. 3, this should be recorded of the person who's been found in possession of any unaccounted material, and this can be used as an evidence. So that is a sworn statement and can be used as an evidence. In case of a 133A, what they say is that 133A says that income tax authority acting under this section may record the statement of any person which may be useful. So there is no statement recorded on oath. This is just a plain statement. So it doesn't carry any evidential value as such. But there is a catch to it. In the first question which Mr. Mehul Patel and I were confronted with, the question was that survey થયો છે અને સર્વેની અંદર મારામાં એક્સેસ મળેલું છે, તો પછી હવે they are treating it not as business income and they are charging me tax as 115 double BE, higher rate, 60 plus. So what should we do? So both of us were of this view that if you had during the course of your statement pointed out that આ પૈસા જે generate થયા છે, જે મારા ત્યાં સર્વેમાં મળ્યા છે, that is on account of my business activity. So it should be taken as business income and not as undisclosed income. એટલે ઇટ ઇઝ અ ડબલ એજ સ્વોર્ડ. પછી ત્યારે ડિપાર્ટમેન્ટ બી જો તમે બી બહુ એવું વાપરવા જશો તો ડિપાર્ટમેન્ટ કાલે ઉઠીને કહે કે ભાઈ હવે સર્વેમાં તમે ડિસ્ક્લોઝ કર્યું હતું તો મને બી બિઝનેસ ઇન્કમ છે, હું નથી માનતો. દેટ ઇઝ અ સર્વે સ્ટેટમેન્ટ, ઇટ હેઝ નો એવિડેન્શિયલ વેલ્યુ. તો યુ મે બી કોટ ઓન અ ક્રોસ ફાયર. સો બટ અધરવાઇઝ ધ લો ઇઝ પ્રિટી વેલ સેટલડ ઓન ધીસ ઇશ્યુ દેટ ઇટ હેઝ નો એવિડેન્શિયલ વેલ્યુ. ધ નેક્સ્ટ ક્વેશ્ચન ઇઝ whether it is the statutory requirement to provide copies of of the statements to the person surveyed. No, there is no statutory requirement કે તમને statement મળવું જ જોઈએ. Only where the statement is intended to be used, at that point of time that statement should be made available. The law of principles of natural justice and equity are very clear that if they intend to use any material against you, that material has to be confronted. If they now intend to use that statement against you, then at that point of time, you are eligible to take this obtain the copy of the statement. Whether the SSC is entitled to cross-examine a person whose statement was recorded during survey, if that statement, as I said, if that statement is being used against you of that third party, which has been recorded, then yes, you have a right of cross-examination. But if they are not using the statement against you, then the question of cross-examination would not arise. So then you cannot insist that I want this a cross-examination. Whether such request for cross-examination could be raised at a later stage of proceedings, that is during appellate proceedings. The question is કે તમારા ત્યાં કોઈ આ એક્શન થયું, તમે ત્યારે કોઈ સ્ટેટમેન્ટનું ક્રોસ નથી લીધું. ફર્સ્ટ અપીલમાં બી there is no ground of appeal, there is nothing raised to that effect that I have been aggrieved by the cross not being granted. CIT appeal, you have furnished your submissions, not raised this issue. For the first time, you now want to raise it, say, in the tribunal. Whether you would be liable or do you have that power by it, whether by way of additional ground or even normal ground. Let's not get into that also right now. My answer is that there is actually no specific authority, but there is one authority against which I'll come to. Tribunal is the final fact-finding authority, and if you are in a position to point out that justice would not be rendered if this cross is not granted, even at a later stage, it is the inbound duty of the tribunal that they should set aside the case, let it go back, and let the truth prevail. Whatever may the facts, that should surface. But unfortunately, Ahmedabad tribunal decision in the case of Pawan Kumar Sanghvi 165 ITD 260 Ahmedabad, which has now travelled to Gujarat High Court. Gujarat High Court has also dismissed the appeal of the SSE, and this matter has gone, SSE had gone and filed an SLP, which has also decided against. That SLP has been rejected. The issue was that accommodation entry was taken by a person, 10 lakhs each. Initially, he said that man who had given the statement, he has given a further statement wherein he has retracted, and therefore no other evidence is required. He placed on record confirmations, bank statements and everything of that person from whom the accommodation entry was taken. Genuineness was doubted. CIT, AO added, CIT confirmed. Even at that stage, they harped and furnished the affidavits subsequent to the statement given by those accommodation entry providers that they have retracted. They had not asked for the copy of the statement. They only placed on record the retraction, that affidavit. Again, they lost there. Before the tribunal, for the first time, they took this plea that then we had made a request and we should be granted cross-examination. But when you had already placed reliance on the affidavit, not challenged the statement, doubting the genuineness, the plea of cross-examination was rejected by the tribunal. That at this stage we cannot entertain such kind of requests, and this matter has travelled. So this is one area. એક વખત તમને એવું લાગે બી ડાઉટ બી હોય ને તો ગ્રાઉન્ડ્સ ઓફ અપીલ રેઝ કરી નાખવા, પછી બહુ ત્યારે પ્રેસ કરો ન કરો, પણ નીચલા લેવલથી ઇફ યુ બ્રિંગ ઇટ ઓન રેકોર્ડ you will be in a much more comfortable position rather than that now you have exhausted all sources, burnt all bridges, and now I want this cross-examination. Probably may not hit well with the judicial authorities.
Serial number 19. Can penalty under section 271C be levied for non-payment or belated remittance of TDS under chapter 17B to the credit of central government? The issue was already under debate long back before the High Court also. One has to first of all look at section 271C. I am reading just for reference. Section heading of 271 reads as under penalty, listen carefully, penalty for failure to deduct tax at source. That is the section heading. Your question is, can penalty be levied for non-payment or belated remittance of TDS? So here question is slightly different. I have deducted TDS, but I have not deposited, or I have deposited but it is late deposition. Okay. Now 271C section heading says penalty for failure to deduct tax at source. Now I am reading subsection 1. Listen carefully. If any person fails to deduct the whole or part of tax as required by or under the provisions of chapter 17B. Chapter 17B deals with TDS provision. That is clause number A, or clause number B. Pay or ensure payment of whole or part of TDS as required by or under. Now they have listed out few sections. One is 1150, which is actually not in relation to TDS, it is in relation to corporate dividend tax earlier. Then 194B, that we are all aware of, that is winning from lottery. 194R, TDS on perquisites. 194S, TDS on transfer of digital asset. And 194BA, that is online winning. Now if you look at 194RS and this 194BA, they are recently inserted subclauses under clause number B. Then law further provides that he shall be liable to a penalty which is equal to the tax which he has failed to deduct. Now this matter came up before Supreme Court. Therefore two clauses are there, I hope you are clear. Clause number A clearly says you fail to deduct TDS as per the provision of chapter 17B. And clause number B deals with fails to pay. But limited sections have been mentioned. I repeat, which are those sections? 1150, 194B, 194R, 194S and 194B. For this, if you fail to deposit, then also there is a penalty. Now this matter came up before Supreme Court. All are requested to note down citation 453 ITR 644. I repeat, 453 ITR 644 US Technology International. Now Supreme Court held as under, on a plain reading of this section 271 CA, no penalty would be leviable on belated remittance of TDS after it is deducted by SSC. Scope of 271C subsection 1 clause A and extent of applications are discriminable from the provision itself in unambiguous terms. Supreme Court further writes, where Parliament intended consequences for non-payment or belated remittance of tax deducted at source, Parliament had already provided for it under section 2011A. We are aware that if you do not deposit in time, you are liable for interest under 2011A. As well as Parliament also provided for prosecution under section 276B. Now Supreme Court says that word fail to deduct cannot be read as failure to deposit or pay tax deducted at source. The Supreme Court clearly says that this penalty will be levied only when you fail to deduct. After deduction, if you fail to deposit or if you make deposit delayed, you are not liable for penalty except for few sections 194B, 194R, 194S and 194BA. The conclusion is very simple. If you fail to deposit TDS for few sections, only then penalty under 271C will be levied. Remaining TDS provision, if you are deducted, but if you fail to deposit, so far as penalty is concerned, it cannot be levied in view of the Supreme Court judgment.
Question number 20. Whether the intimation under section 143(1)A of the Act for the assessment year 1920 making adjustment or disallowance of employees' contribution to the provident fund in the terms of section 143(1)A(4) of the Act on the ground that the said government dues were paid beyond the due date prescribed under the PF Act, although before the due date filing of the ITR under section 139 of the Act, 139 into bracket 1 of the Act is valid. Now this is the question regarding the prima facie adjustment under section 143(1)A. Now the adjustment as provided under clause A, and in this query it refers to subclause 4. I read subclause. The total income or loss shall be computed after making the following adjustment, namely subclause 4. Disallowance of expenditure indicated in the audit report but not taken into account in computing the total income in the return. So it is clearly provided that if the auditor is make a qualification or remark in his audit report that this is the expenditure towards the EPF, it is paid in violation of the labor laws applicable to the in the case of the SSC, then as in the case of Tarun Construction Company versus ITO, Jodhpur Tribunal has held that it is disallowable under section 143(1)A. This kind of adjustment can be made by the department. Citation is 157 taxman.com, page 727. Tarun Construction Company versus ITO, following the decision of the Honorable Supreme Court in Checkmate Services Private Limited, 448 ITR 518. This is the judgment of Jodhpur Tribunal. Now another judgment is in favor of the SSC. The judgment of the Mumbai Tribunal, RP Packaging Services Limited versus ACIT, 101 ITR Tribunal short note, page 8. In this case, the tribunal has held that it is not within the ambit of the prima facie adjustment under section 143(1). Tax auditor's report is mere an opinion of the auditor, and therefore it could not be falls within the meaning of the adjustment as provided under clause A. So there are two different judgments of the tribunals, but after the insertion of the amendment made to this section and the judgment of the Supreme Court checkmate, this is the controversy before the appellate forums. So in my opinion, this is categorically provided the disallowance of expenditure indicated in the auditor's report, if it is not taken into account in computing the total income, prima facie adjustment can be made. PR packaging services, 101 ITI Tribunal, page 8.
Question number 21. It relates to 263, that where the assessing officer has allowed certain deductions in 143(3) assessment, can the CIT take action under 263 only on the ground that inquiries are not made by the AO and without independent inquiries made by the CIT, and invoke explanation 2A of the Act, 2A to section 263. Friends, this is a very interesting issue because explanation 2, which came into effect from Finance Act 2015 with effect from 1st June 2015, it says that an order will be deemed to be erroneous and prejudicial to the interest of revenue if, in the opinion of CIT, the order is passed by the AO without inquiries or verification which should have been made. The last 4 lines are very important, which should have been made. So friends, in certain cases, we find that even if we give detailed explanation to the CIT in response to 263 notice, then he says that yes, your contentions are okay, but this aspect was not verified by the assessing officer, so I set aside the order to the file of the assessing officer, without pointing out any infirmity in our submissions or without pointing out as to what type of inquiries or verification is required to be done in this case in order to term the order as erroneous and prejudicial to the interest of revenue. Friends, now it is settled by 2 or 3 judgments that such type of blanket set aside without pointing out any inquiry, without carrying out any independent inquiry by the commissioner or without pointing out any error in the order is not valid. For this, I will just point out 2 or 3 judgments. Even after explanation 2A, Punjab and Haryana High Court, in the case of PCIT versus Kanin India, this is 141 taxman.com, page 83, which says that where revision order was passed by PCIT holding that assessment made by the AO was erroneous and prejudicial to the interest of revenue, as the assessment order has been passed without making any inquiry or verification. However, the PCIT was not in a position to point out as to what inquiries or verification should have been made, but had not been made by the AO, so as to make the present case fall within explanation 2A of section 263. The tribunal rightly set aside the order passed by the commissioner. And similarly, the Ahmedabad tribunal, in the case of Comtrade Commodities Services, 156 taxman.com, page 369. 156 taxman.com, page 369. The Ahmedabad tribunal says that there has to be a finding of error causing prejudice to the revenue by PCIT for valid exercise of revisionary power under section 263, and as verification precedes the finding of error, any discretion for verification of the claim under section 263 is not in consonance of the requirement of law. So friends, the law is that it cannot be set aside to the AO to find out error, whether there is error or not. The PCIT has to first inquire, has to make verification, has to prima facie establish the order to be erroneous. Only thereafter he can set aside. But a blanket set aside, a blanket second inning is not justified, even after 2A.
Question number 22. In the context of CERT, the following issues need to be answered. There are 3 issues which have been raised. The first is whether it is adequate to place heavy reliance on the appraisal report. Friends, as you all are aware, that post-search proceedings, the controlling ADI, the one who has conducted the search, will prepare a detailed appraisal report. That appraisal report would be taking into consideration the facts of the case, the basis of information which they had, the investigations which they did prior to that, inquiries conducted prior to the search, what led to this, what was then unearthed during the course of search in terms of assets, in terms of modus operandi of the business and whatever. Their report would be considered as best a consultancy, a recommendation that this is what we feel that we have conducted a search. So the question is, yes, whether heavy reliance can be placed. Now, reliance you don't have to place. The reliance has to be placed by the department. So you have nothing to do whether the reliance is being placed. Technically, this report is confidential. You are not even supposed to be aware of its existence or the contents thereof. Now, definitely, appraisal report has persuasive value. You cannot discount that fact, though it has no evidentiary value. But it has persuasive value. For the central assessing officer of the central circle, it is more like a Bhagavad Gita. He is going to stick to that appraisal report and proceed with the investigation. You put cogent, credible, reliable evidences to dispel the doubts which have been cast on account of the appraisal report, but you'll need heavens to move them. I'm telling you for sure. The appraisal report has assumed so much importance that in case if the assessing officer wants to deviate, there is a special committee which comprises of the assessing officer of the central, your assessing officer, the additional of the central range where you are being assessed, that concerned ADI and the additional DI. They all will sit, ponder. If they intend to deviate, they have to discuss with them. So that is the persuasive value of the appraisal report. So therefore, whether it is adequate to place reliance on the appraisal report is not in your hands. The best thing you can do is you can place your evidences to suggest that no, the findings in the appraisal report at best are recommendatory. Please look into my evidences and do not rely blindly on them. B, whether such report is of any relevance for the purpose of assessment. Definitely it is. As I told you, the assessing officer in case of a search relies heavily upon the appraisal report. Though the observations, they are not conclusive. The appraisal report also is at best a report, as I said. And even the person who is authoring the appraisal report puts in his disclaimer. Okay, I have done this, but you verify at your end. Due to limited time constraints, we have been able to do this. You can do that. You can conduct further investigations if you want. So whether it has relevance for assessment, yes, it has relevance for assessment. If they have suggested that no, we have found evidences of any unaccounted investments made in land, they may also, advise in the report that you please refer to the DVO for further verification. So those kind of things are there and they have a bearing on they may also say that there is complexity in the accounts. We would recommend special audit to be undertaken in this case. So these kind of suggestions may be there, which, as I said, can have persuasive value. Can the assessing officer go beyond the quantum determined in the appraisal report? The sky is the limit. AO can go to the entire galaxy by appraisal report. Nobody can stop them. Fortunately, there are two further layers, but otherwise, AO is bound. AO can go beyond. In case AO doesn't want to cross what has been stated, he has to go to the deviation committee and everybody looks into their own service records. They generally don't help you out. This is from a practical situation which I am telling you. There is no, because in any case, appraisal report does not form a part of the statute book. It's at best a confidential report prepared internally and it is for their internal consumption. So that would be my answer to this query.
Serial number 23. Can prosecution proceedings under section 276B be launched for delay in depositing tax to the credit of central government, where the period of delay and the amount of TDS were not substantial, and the amount of TDS has been subsequently deposited with some delay along with interest? Here, the question raised on section 276B. Let me read that section first. It says that if a person fails to pay to the credit of central government tax deducted at source by him as required under Chapter 17B, he shall be punishable with rigorous imprisonment for not less than 3 months, but which may extend to 7 years. The law is very clear that if you fail to pay, here the word is categorically written, fail to pay to the credit of tax deducted at source by him. And that should be within the provisions of Chapter 17B. That means if you do not meet timeline, then punishment will follow, and that punishment is not a simple imprisonment. It is rigorous imprisonment and with a minimum period of 3 months, which may extend to 7 years. But here the question is that I have deposited, delay is very short, I have deposited along with interest, and the amount involved is not substantial. Still, I will be subject to imprisonment. That is the question. I request all of you to note down one citation of Supreme Court of 2023, 454 ITR 59. I repeat, 454 ITR 59. It is Dev-Prabha joint venture and others. In this case, Supreme Court says that considering CBDT circular, I request all of you to note down CBDT circular also. I'll share glimpses of that circular as well. It is circular number 24, 2019, dated 9th September 19. I repeat, circular number 24, 2019, dated 9th September 2019. This circular is applicable for all offences. It is not only for TDS default. The one should read this circular. What Supreme Court has observed in this case, considering the CBDT circular where it is mentioned that prosecution under section 276B shall normally not be proposed when amount involved or the period of default was not substantial, an amount in default had been deposited in meantime to the credit of central government, and accordingly caused the criminal proceedings, an order passed by Special Economic Offences Court against the SSC holding that tax deducted source in all cases had been deposited with interest, though there was some delay in depositing tax. Moreover, in 1 or 2 cases, deducted amount was not more than 10,000, and therefore Supreme Court upheld the decision of High Court and dismissed the special leave petition. So here amount involved was less than 50,000, delay was also not much, and deposit was done along with interest. Now let us look at the CBDT circular, which is very important. That what kind of amount CBDT circular mentioned. CBDT circular state that no prosecution will be processed if TDS or TCS amount does not exceed 25 lakh rupee. So this is limit is circular itself says 25 lakh rupee, and delay in deposit is less than 60 days. Therefore, amount involved is less than 25 lakh and you have done a delay in deposit of TDS. But if it is not exceeding 60 days, then in these cases, generally prosecution should not be launched. But it gives or it carves out one exception also, that if that person who is habitual defaulter, that is regularly commits default, then he should not be given benefit of this circular. So with this I end. Thank you.
Question number 24. Whether the remuneration payable or paid to the partners of the firm is subject to the TDS provisions. Disallowance under section 40 IA for non-deduction of tax on remuneration to partners permissible. Whether partner is NRI, does your answer remain same? Now in this query there are 2 parts. I will take the first part. This is the issue of disallowance under section 40 IA, non-deduction of tax or failure to deposit the tax. That is the disallowance. Now the remuneration paid or payable to the partners of the firm. 40 IA covers the payments under the head salary also. Now the payment of remuneration to the partners, whether within the definition of salary or not. Explanation to below section 15. Explanation 2 provides that any salary, bonus, commission or remuneration by whatever name called due to or received by a partner of a firm from the firm shall not be regarded as salary for the purpose of this section. So it is not within the meaning and definition of salary, and therefore section 192 is not applicable, and therefore there is no question of any TDS and there is no default under section 40 IA. So there is no disallowance is permissible. Direct judgment is ACIT versus Dhar Construction Company 101 ITR SN 49 Guwahati Tribunal. This is direct judgment. Now in this case, no TDS, no disallowance, no applicable. Repeat. 101 ITR, page 49. But it is slightly different where the partner is NRI. For that purpose, I refer section 195. 195 clearly provides that any person responsible for paying to a non-resident, not being a company or to a foreign company, any interest not being interest referred to in section 194 LB or section 194 LC or section 194 LD or any other sum chargeable under the provisions of this act, not being income chargeable under the head's salaries, shall at the time of credit of such income to the account of the payee or at the time of payment thereof in cash or by issue of check so and so, so and so. If Modi so in the case of the partner having status of NRI, the TDS provisions are applicable under section 195, but if the it is not within the, then there is no case of any TDS required because it is not within the meaning of the salary and therefore 40 IA not applicable.
I am taking up question number 25. Broadly, the issue is the applicability of section 50C vis-a-vis section 54, investment in residential house. In short, the fact is that the Jantri value is 7 crore rupees, the sale deed is for 5 crore rupees, and he has invested in new residential house of 5.50 crore. The department is saying that since the Jantri is 7 crore and you have invested 5.50 crore, so 54 deduction will give proportionate and not the whole of it, whether this is justified or not. Friends, this is clearly not justified because section 50C, the deemed full value of consideration, has a limited application for the purpose of section 48 only, that is for computation of capital gain. It is clearly mentioned in section 50C itself. This 50C cannot control or cannot govern the applicability of section 54. 54 is absolute in terms. It clearly says that once you have invested the entire net consideration, the definition of net consideration is there in 54 explanation. It says that full value of the consideration as reduced by the expenses incurred wholly and exclusively in connection with the transfer. That is the only thing. So if in this, the facts of the poser, the sale deed value was 5 crore and investment is 5.50, so the provisions of section 54 are clearly met out and he is to get the entire deduction of 5.50 as invested. Now it's a different matter that the Jantri value is 7 crore. So for the purpose of 48, according to me, in my humble opinion, unless you are able to show, unless you make the, you request the AO to make a reference to the DVO and get the value reduced, but otherwise for the purpose of 48, it would be a deemed value of 7 crore for the purpose of computation, But for deduction under 54F, you will get deduction of 5.50 lakh. For this, there are direct 2 or 3 judgments which I would like to point out. The detailed judgment is in the case of Lalit Kumar Kalwar, ITIT Jaipur bench, 156taxman.com, page 27. And another judgment is in the case of Chennai Tribunal, Mrs. Bhaskara Babu Usha, 135taxman.com, page 307. 135taxman.com, page 307, Chennai Tribunal. Friends, in these judgments, one of the view was that if you invest the entire consideration, then there is no applicability of section 50C. But that, according to me, would result in a very absurd situation. Because take for example, that if the Jantri value is 10 crore rupees, you enter into sale deed for 5 crore and you invest 5 crore or more than that, say 6 crore in residential house, then can it be said that 50C will not have any application for the purpose of 48 also? In my humble opinion, that cannot be the intention of the legislature. Only thing is that once you invest the entire sale consideration as per the sale deed, then for 54 you should get the entire deduction. The last portion of the query is that will it make any difference if the amount Jantri value is 11 crore and Jantri value is 13 crore and amount invested in house is 11.50 crore. Now there is a cap, friends, that there is a cap of 10 crore rupees. The second proviso has been inserted to section 54 by Finance Act 2023 with effect from 1/4/2024. Now you will get a deduction maximum of 10 crore rupees. So in the given facts of the case, you will get 10 crore and not more than that, even though you have invested 11 crore. And your question was regarding 50C. I would only say that if we apply the logic of this discussion that I just gave, 50C has a limited application for 48 for purpose of computation of capital gain only. If 50C, some addition is made, it cannot be taxed under section 68 and 115. It will be taxed as capital gain only.
Question number 26, and before I answer this question, I would thank the organizers for inviting me. This is my last question, though there is one question named under my name, but that has already been allotted to Mehul. I had a talk, so Mehul will take up that question. So thank you very much, and I'll take up the last question now. Once again, it has got 4 sub-questions. Gold ornaments of 4 kg were brought in a foreign country into India by a family of 4 persons, husband, wife, son and daughter, after the payment of applicable custom duties in foreign exchange. Search was initiated under section 132 and the gold was seized. The first question is whether such payments of custom duty will absolve the liability of a person to satisfy the gold ornaments was purchased from income lawfully earned. Let me explain. This will be slightly different in this sense that we will be now dealing with slightly different than income tax, which would be Black Money Act. Black Money Act has been recently introduced and has got draconian consequences. And this is primarily applicable, not primarily, only applicable to Indians, the residents. Now what does it say? That any Indian resident, he is duty bound to report any income which arises from any source outside India or acquires or holds any asset located outside India. In the return, he has to disclose. Now look at the question. This family is Indian. They have been traveling. They have purchased gold outside. So either that person will have to establish that he has taken permissible foreign exchange from India, from his accounted sources, traveled abroad, purchased the gold from there, returned, paid the custom duty, then he's fine and scot-free. But merely he goes there, purchases gold, on the return he says, I'll pay my custom duty, not in a position to explain the source of acquisition of that 4 kg gold, he is in deep trouble with the Black Money Act, which has got, as I said, draconian effects. So that is first thing, that this is a resident has to report his income. Secondly, there is a specific schedule FA in the return of income where all residents have to report if they have any foreign assets or any foreign income arising. So that has to be entered mandatorily. He cannot escape from that. So these two for the resident are there. Now, what are broadly the elements of the applicability of the Act? Firstly, this person has to be an SSE, which a resident would be in normal circumstances. He should be the resident in the year in which either this asset was acquired or the income earned, or in which this notice under Section 10 of the income of the Black Money Act has been issued to him. So only if he is a resident would this come to be applicable. The foreign income or asset should be of an undisclosed nature. It should be from a source located outside India and chargeable to tax in India under the Income Tax Act. Even the undisclosed foreign asset may be located outside India. So therefore, primarily if this person is an Indian citizen or Indian resident and he's bringing in this 4 kg gold, he's in deep trouble, as I pointed out. He will be liable to pay not only 30% taxes, 300% would be the penalty, and apart from that, there is imprisonment charges also in Black Money Act. So, secondly, there is no such thing as number of years. There is no time limit. Reopening can be done for X number of years. So, 40 varas pehla bhi, if it is found, you can still be charged in Black Money Act, though not under Income Tax Act. So, this is something very serious. So, this man will be probably in deep trouble under the Black Money Act, not under the Income Tax Act. Can the family claim blanket benefit of various limits specified in Board Circular number 1916, dated 11? If you recall, the instruction is that in case of a search, તમારી પાસે jewelry per lady 500, married lady છે 500 grams, unmarried lady na 250 grams છે, and other male members na 100 grams. So in this context, probably this question is being asked કે આ 4 કિલોમાંથી મને આટલા તો મને રહેવા દેશે કે નહીં રહેવા દે. જો તમે ત્યાં જ જો પકડાઈ ગયા પહેલાં બ્લેક મનીમાં તો તમારી પાસે સોનું જ નહીં હોય, એટલે એ બહુ ચિંતા કરવાની જરૂર નથી કે મારી પાસે આ હશે કે નહીં ઇન્કમ ટેક્સના રેડવાળા માટે. પહેલી એ વસ્તુ છે. સર્ક્યુલરમાં દેર ઇઝ નો સચ કન્સેપ્ટ. આઈ થિંક કે યસ એને એ બેનિફિટ શુડ ગો, because there is no such concept કે આમાં બ્લેક મનીવાળો છે કે નહીં. એમાં the case is very simple. The instructions are these કે આ તમે you should be આટલું રિલીઝ, it should be treated as deemed explained. એનું એડિશન બી ન થવું જોઈએ. Not only that amount, the gold should not be seized, but it is deemed to be explained. And there are plethora of decisions, I'm not getting into them, where the additions have come to be made in respect of such which are within the limits. કે એ કહે છે કે મારા ત્યાં આવ્યા હતા અને 350 ગ્રામનું મારા ત્યાં સોનું મળ્યું, પણ મેં 250 ગ્રામના જ બિલ આપ્યા હતા, એટલે 250 ગ્રામ મારા જતા કર્યા છે અને 100 ગ્રામ મારું એડ કર્યું છે. But if it is within that limit of 500 grams, no, I think he should get the benefit. Would there be any difference if the SSE is a resident or a non-resident? Definitely, if he is a non-resident and custom duty has been paid, he can always claim that this is from a source outside India. I am not liable for any income. This income has not been generated in India, so I am not liable for any taxes. And Black Money Act is also not applicable to a non-resident. So he is in a much better position. Fourth, any other issues which may come up, I think these are enough. I don't think he should need any more issues to be confronted at this stage. So once again, I thank the audience and the organizers for this opportunity which had been granted to me. Thank you so much.
Serial number 27. SSE earned a capital gain of 1 crore 80 lakh on sale of immoral property. However, he neither paid tax nor submitted income tax return for the relevant EY. Thereafter, he was subjected to reassessment proceeding under Section 147 of the Act. Department also launched prosecution. Matter traveled up to tribunal, and tribunal declared assessment order null and void, but on the technical ground of limitation and not on merits. The order is barred by limitation. SSC seek to quash the prosecution on the ground that ITAT had set aside the assessment order. Whether the plea of SSC is maintainable. I request all of you to note down a very interesting citation on this. It is S.J. Surya versus Deputy Commissioner of Income Tax. 139 taxman.com, page number 3, Madras High Court. I repeat, 139 taxman.com, page number 3, Madras High Court, para 19. I am reading this, Honorable Madras High Court. Essentially, ITAT disposed the appeals only on the ground of limitation and not on merits. It is further observed that other grounds relating to merits become an academic exercise, meaning that other issues raised in the complaint, especially the issue raised in the complaint with regard to non-filing of return, non-payment of advance tax, non-payment of tax demanded, suppression of true and correct income by not filing return, had not been considered by the Income Tax Appellate Tribunal. When the matter was not decided on merits, but only on technical ground of limitation, this court is of the considered view on the basis of principles settled in 3 SCC 581 Radheshyam Kejriwal versus State of West Bengal, that petitioner cannot seek to quash the proceeding on the ground that tribunal had set aside the assessment order. So only on this ground he cannot seek the relief. He has to prove no culpable mental state. Thank you.
Hello. Very fair. It is faithful to you. Position. Question number 28. The assessment is made on presumptive basis under section 44 AD of the Act. Whether additions for the unexplained cash credit under section 68 read with section 115BBE of the Act applying the higher rate of tax is permissible? No. This is the query regarding presumptive taxation under section 44 AD. Special provision for computing profit and gains of business on presumptive basis. Largely under this section, no books of accounts is required to be maintained by the SSC. Earlier we have discussed 44 AD, 44 ADE, we have already discussed. So under the presumptive tax regime, the SSC is not required to maintain the books of accounts, and in the absence of books of accounts, there is no question of applicability of section 68. When section 68 is not applicable, there is no point of applicability of 115BBE. I may quote one judgment of the Jodhpur Tribunal, Sumit Goyal versus ITO, 106 ITR, Tribunal, page 695. Bangalore ITAT in the case of Mahendra Kumar versus NFAC, appeal number 423, /BANG, Bangalore, /2023. Another judgment of Cochin bench, Thomas Epan, ITA number 451, /COCH, Cochin, /2019. And another one judgment of Chandigarh bench, Nanlal Popli versus DCIT, ITA number 1161 and 1162, /CHD, Chandigarh, /2013. So there is no case of any applicability of 68 read with section 115BBE.
Question number 29. This is a currently very burning issue as far as trusts, registration of trust is concerned under section 12, new regime of 12A, 80G, etc. Broadly the question is that the trust was registered, provisionally registered under 12A and 80G. Thereafter it filed application under section 10AB on 20th September 2023. The CIT exemption is proposing to reject it as being time barred. Friends, we know that 80G5 proviso subclause small Roman 3 has provided a time limit. It says that when there is a provisional registration granted, then the final registration application has to be done by the SSE, by the trust, within 6 months prior to the expiry of the period of the provisional approval, or within 6 months of the commencement of the activity, whichever is earlier. Now friends, this time limit was extended time to time by circulars of the department. The first circular is circular number 8 of 2022, dated 31st March 22, which extended the time limit up to 30th September 22. And thereafter, the latest circular is circular number 6 oblique 2023, dated 24th May 2023, which has extended the time limit for filing Form 10AB up to 30th September 23. So friends, as far as this fact of this case is concerned, the application is within time because it is filed on 20th September 23 and circular has extended up to 30th September 23. But the only difficulty, the major difficulty is that in the earlier circular, circular number 8, they had covered cases of 3 types: application under section 12, application for 1023C and ATG. Whereas in the latest circular, which has extended up to 30th September 23, they have included only 2 items, 12A and 1023. They have omitted ATG. Now this is what is being attacked by the CIT exemption, that for ATG there is no extension. There is extension only for 1023C and 12A, so ATG is time barred and we will reject. Fortunately friends, we have 2 beautiful tribunal judgments and both are of jurisdictional tribunal, one Ahmedabad tribunal and the other of Surat tribunal, which are of immense help and directly on the issue, and they say that nothing doing. This is a clear case of hardship to the SSE, and in the interest of justice, even the tribunal has got the power to extend the time limit. I would like to share the details of the judgments. The Ahmedabad tribunal is in the case of Best Buds Pet Care, ITA number 731, oblique Ahmedabad, oblique 2023, dated 30th November, 30 November 2023. And they have applied the latest circular to 80G also and remitted the issue to the file of CIT exemption to decide on merits. And a more detailed judgment is of the Surat tribunal in the case of Vananchal Kelauni Trust, 159taxman.com, page 634. 159taxman.com, page 634, 634. This is a very beautiful judgment, friends, where they have analyzed 2 things. Firstly, they said that these provisions of this provision of 6 months and new registration will apply only to the new trusts created after these provisions came in the statute book, because of the simple logic that if there is an old trust, say 5-year or 10-year-old trust, then how can you expect the SSE to apply within 6 months of the commencement of the activity? It is impossible. Old trust જે હોય 10 વર્ષથી ચાલતું હોય 6 મહિનામાં કઈ રીતે કરવાનું છે from the start of the activity? So they have clearly stated that these provisions are applicable only to new trust. And secondly, they have analyzed the difference of the 2 circulars also, difference of language in the 2 circulars. And they said that in the interest of justice, to reduce hardship to the trusts, and they said the tribunal being the final fact-finding authority in the country, we have the power to condone the delay. And they said that we condone the delay and remit the issue to the file of the CIT exemption. And likewise, we have another judgment also of another tribunal, which I would just like to share the citation. ચોક્કસ. આમાં કે પેલા? Yes. This is Pune Tribunal in the case of TB Lulla Charitable Foundation ITA number 1220, Pune, 2023, judgment dated 5th January 2024.
I would just like to add one more thing to what Mehul Bhai said. In the case of Surat Tribunal, it has not been remitted. The registration has been granted. It has gone one step ahead, the tribunal. But secondly, I would request and suggest and recommend, what is going to happen is that department is definitely going to go to the High Court. This is a legal issue. So again, tomorrow, what is going to happen in the High Court is going to be a dicey affair. Please alternatively make an application under 119 to the board. Board is going to take a lenient view in this matter. That is the feedback. And they are going to resolve all these issues before 30th of September of this year. So in case, even if the matter is pending before the High Court, if you have a 119 condonation application pending before the board which successfully decides against you, you will be free from all litigation in future also with regards to the registration.
And friends, one more thing, that while we are addressing at such seminars which are organized at such a global level, all Gujarat Federation or whether it is all India Federation, I would request that these federations through the office bearer should make a representation to remove the anomaly of the two circulars, because the latest circular does not include ATG. It is an obvious error on the part of legislature. So we should all make a joint representation, because it's a question of so many genuine trust. And I am told that these days the CIT exemption is on a mission to reject such applications. He has rejected hundreds of applications, and unnecessarily all have to file appeals to the tribunal and enter into long-drawn litigation. And I would also be taking up question number 30, which has been gifted by Aseem Bhai to me. This is also on trust.
56 is applicable, you'll have to wait.
So this is also on trust. The question is that ABC College Alumni Association, which is provisionally registered under 12AB, it made application for final registration on 23rd September, so it is within time. Thank God it is under 12 and not ATG. The CIT is proposing to reject on a different ground, that since it is limited for the benefit of students of a particular college only, it is not for general public utility, for public utility, so I will not grant you registration. What is the remedy available? Friends, fortunately, we have a direct judgment of an alumni association itself of the Vishakhapatnam Tribunal in the case of SRK REC Alumni Association in ITA number 533 oblique Vishakhapatnam oblique 2017 dated 23rd February 2018. This was also an alumni association where they said that the objects are charitable in nature, because 215 does not say 215 or 12AA only says that the CIT has to examine the genuineness of the objects in the activities. They are prima facie of a charitable nature, and they said that even if it is an alumni association of a college, of a particular college, but the students are belonging to various caste and religion, they are belonging to all parts of India. So it cannot be stated that it is a limited application. It has to be stated that it is for general public utility, and they applied the analogy of two judgments. One is Supreme Court judgment in the case of Ahmedabad Rana caste, which is 82 ITR page 704. It is mentioned in this judgment. In Rana caste judgment, which emanated from Ahmedabad Tribunal, Gujarat High Court held in our favor, which went up to Supreme Court, and we won in Supreme Court also. It says that an object beneficial to a section of the public is also an object of general public utility. To serve a charitable purpose, it is not necessary that the object should be to the benefit of the whole of mankind or persons of a particular country or state. It is sufficient if the intention to benefit a section of the public as distinguished from the specified individual is present. So it is not necessary that आखी दुनिया ने helpful थवु जोईए. Even if it is a section of a public, it is all right. It is for public utility. And likewise, they also applied the analogy of another decision, which is Andhra Pradesh Police Welfare Society, 148 ITR 287. there also they applied the logic of Ahmedabad Rana caste, and they said that 12A is to be granted. So friends, with this, I come to the end. This was the last question. And before I part, I thank the organizers, the presidents, and everybody for giving me this opportunity. And I thank all of you for a patient hearing. Thank you.
Serial number 31. This is an issue pertaining to Section 263 of the Income Tax Act. We know that Commissioner is empowered to review the order passed by subordinate authority with a twin condition of order is erroneous and prejudice the interest of revenue. But we also find, and we are also finding this time also, that they come out with these so-called notices at the fag end of limitation. Because normally time limit is 2 years from the end of financial year, in which that order under subject to revision is passed by the assessing officer. So normally what they do is they give these notices at the fag end. The same is the case here. If you look at, the notice was issued on, so-called notice was issued on 26 March 2021. And the order was passed finally on 31st March 2021, rejecting the request of SSC for a grant of 15 days time. The reason was it was about to time bar on 31st March 2021. So will this kind of order will sustain when it has practically not given an opportunity of being heard? I request all of you to note down recent judgment of Orissa High Court on this. Actually, a tax appeal number is not available, but you can note down the entire name. It is Messrs. Dhaneshwar Rath Institute of Engineering and Medical Science. I repeat, Dhaneshwar Rath Institute of Engineering and Medical Science. An order is dated, a wonderful date is there, it is Valentine Day, 14 Feb 2023. I am reading para 5.10, 5.11 and 5.12 of this judgment. It is this, in the instant case, notice contemplating initiation of proceeding of revision was issued on 26 March 2021. An order in revision was passed by rejecting request of adjournment on 31st March 2021. Supreme Court, now Orissa Court is referring Supreme Court in case of Zenith Metaplast Private Limited, laid down that anything done in undue haste can also be termed as arbitrary and cannot be condoned in law. Therefore, Orissa Court says we will not set aside to the table of Commissioner. We will quash this order. And 5.12, Orissa Court says therefore learned ITAT was correct in holding that CIT passed the order without giving an opportunity of being heard to the SSC. And on the said ground, CIT is not justified in directing assessing officer to redo the assessment. So this kind of order will be treated as without opportunity of being heard and liable to be quashed. And the Orissa High Court referred to the Supreme Court judgment of Zenith Metaplast. So with this, I am thankful to the AGFTC President and the office bearers giving me one more opportunity to address the August gathering. And I'm also thankful to all of you for a patient hearing. Thank you.
Now the last question. Wait for me. The tax recovery officer adjusted the amount of refund in excess of 20% of the total disputed tax demand. Whether such action is within the jurisdiction available to the TRO? No. The query clearly reflects that the SSC has been treated as the defaulter because it is with the TRO, not with the assessing officer. The case is under the jurisdiction of the TRO. Indication, it is very much clear that 20% of the total disputed demand has been already recovered. If such power is given to the TRO to recover in excess of 20%, then the whole purpose of that CBDT instruction number 1914 dated 2/12/1993 will be defeated. Office memorandum dated 29/2/2016 and subsequent office memorandum dated 31/07/2017, which give the instructions to the assessing officer and the tax recovery officer to recover the disputed tax demand to the extent of 20%, and if the SSC pays the 20% of the disputed demand, he is duty bound to stay the balance demand till the disposal of the appeal before the appellate forum. Now, in this case, already 20% has been recovered by the TRO. He is going to recover more than 20%. Now, if we see the provisions of section 245, the TRO is duty bound to give the opportunity to the SSC before making any adjustment to the refund eligible to the SSC. If he wants to adjust any refund available to the SSC, the opportunity should be given to the SSC. If any objection, the SSC can raise the objection. So in this case, the SSC can raise the objection because he has already recovered more than 20%. Now, thank you very much. I am very much lucky to be here on the dais with the eminent brain trustees, and I am thankful to the organizers, the president of the All Gujarat Federation of Tax Practitioners and the Income Tax Bar Association, Ahmedabad.
Hello. Thank you so much to all the brain trustees for today's discussion. On behalf of Income Tax Bar Association and AGFTC, I thank all the trustees for enlightening us with their knowledge, experience and expertise. One important announcement is there. We are open with the registration for Tax Conclave 2025 and we have already crossed 50 plus registrations. And 5 a.m. So I request all the participants to please be on time. Thank you each and everyone for joining us and being part of this mega conclave.